What's up, guys? It's your boy, Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Alibaba, ticker symbol BABA, trading for $251 as of August 1st, 2020, equating to a market cap of $680 billion and a PE or price per earnings ratio of 31. Alibaba is up 42% from its 6-month low seen in late March. I would like to compare a handful of large American companies to their Chinese counterparts under the Alibaba umbrella in an attempt to extrapolate our expectations for Alibaba's next earnings. And yes, here at Quick Stocks, we understand that it's not an apples to apples comparison, as companies who operate under the Chinese Communist Party adhere to different economic guidelines than large American capitalist corporations. However, pump the brakes. Regardless of the country that these businesses operate in, society has still become reliant on these services, and we think this information will help investors when it comes to making a decision on if Alibaba is over or undervalued. Anyways, let's get into it. This is your quick stock analysis. It only feels right to start our comparison off with the e-commerce behemoth Amazon, who crushed its Q2 2020 earnings last week, where revenue was up 40% to nearly $90 billion, with a net income of $5.2 billion. Usually, the law of large numbers makes it hard for these titans to make a sizable impact. However, Amazon reported a 33.5% worldwide revenue growth in the second quarter. And of course, Amazon's cloud computing, AWS, reported a revenue of $10.8 billion, up 29% year over year. I'm sure some of you are thinking, great, so what does this have to do with Alibaba? Well, remember, they both operate the largest e-commerce and cloud platforms in their respective country. It's interesting nonetheless. Amazon is up nearly 90% from its lows seen in March, but Alibaba has only seen around a 40% correction in the same time frame. Perhaps Alibaba doesn't have the same catalyst? Well, once again, pump the brakes, boys. Here at Quick Stocks, we would argue that that doesn't paint a complete picture of Alibaba. Remember, Alibaba handles more business than any other e-commerce company with its Taobao, Tmall, and Alibaba platforms. One could extrapolate Amazon's online retail success during the global quarantine in North America to Alibaba also seeing a sharp increase in sales in Asia. Just to really put this into perspective, China booked nearly $2 trillion in e-commerce sales in 2019, more than 3 times the United States, which is in second place with $587 billion. China, on its own, represents 55% of the global e-commerce market, nearly twice the share of the next 5 countries combined. And on top of this, as of fiscal 2019, Alibaba made more money than Amazon. However, we should note the company's income as of the quarter ending March 31st, 2020 actually saw a decrease in income of 19% year over year. This was primarily due to the impact of the Rona pandemic. And for any investor, this is a huge red flag. The company's net income decreased 99% year over year. However, this wasn't due to a weak active consumer base. In fact, the company continues to hit new milestones. This decline was primarily due to a net loss in its investment income, meaning a decrease in the market price in its assets, such as its investments in publicly traded companies, which may hold a grain of salt. After all, many companies were still down 50% or more from their highs seen during this period. If the market can remain strong, one could expect a massive quarter-over-quarter increase from Alibaba. Anyways, moving on. Of course, Alibaba is one of the world's largest e-wallets. So let's take a look at another quick stock favorite company, PayPal, who has seen a historic rally of 130% from its March lows. This is yet another company who crushed it as the world adjusted to the global quarantine. The company reported transactions were up 20% year over year, with branded transactions up 43%, more than double pre-COVID levels in January and February. Well, of course, Alibaba is also a massive player in this market, with Alipay. I gotta note, China has been the fastest country to adapt digital payments. When visiting China, depending on the region, if you were to give money to someone asking for change, it would probably be through a Cash App. Many Chinese don't carry or accept physical currency anymore. It's crazy. Remember, yes, worldwide PayPal is still the leader and will most likely retain that title. However, China offers a massive market with nearly 1.5 billion people. Let's just say, even if Alibaba can't expand its reach out of China, it should have an insane market growth for decades to come. And since we were speaking about PayPal, it only feels right to take a look at eBay, who of course is one of the leading consumer-to-consumer businesses. The company is up 110% from its lows in March, as the pandemic has forced many people looking for that fast cash or with spare time during quarantine restrictions to sell their goods. Well, you guessed it, Alibaba is also in the market with its company Tobo, which means search for treasure in Chinese, with over 300 to 400 million daily active users. This part of Alibaba's business model facilitates small business to consumer and consumer to consumer trade by allowing small businesses and individual entrepreneurs to list their products on their website for sale. Fun fact, Tobo became such a massive hit, it forced eBay to close its stores in China in 2006. Let's quickly look at one more company before getting into the bear case and finally our expectations. Switching it up and taking a look at the transportation sector, we can see even FedEx has seen an 86% increase from its lows in March. Alibaba's counterpart, Canoo Networks, which is honestly more similar to Amazon delivery, is dedicated to meeting the current and future logistic demands of China's online and mobile commerce sector. The company is trying to reach delivery anywhere in China within 24 hours and across the globe within 72 hours. The company also has smart warehouses and pickup stations, and the future is promising as Alibaba is investing $141 million to ramp up the company's abilities. I certainly could keep going, including electric vehicles, 5G, autonomy, music, and so on. It's really kind of mind-blowing when you consider the reach that this company has. An investor has to ask oneself, with such a massive market exposure and solid moat, how is this not a trillion-dollar company yet? Leading us into our quick stock bear case for Alibaba. The main factor an investor has to consider is the growing uncertainty as tensions between the US and China escalate. The CCP, or Chinese Communist Party, is one of the reasons Alibaba has been able to become such a massive success. Realistically, it's hard to imagine Alibaba growing to the scale, at least initially, as it was able to do in China. However, remember, the CCP has a ton of say on how the company is ran, be it for the good or bad. And while talking about the CCP, I gotta note, Alibaba is a variable interest entity, or a VIE. You may be more familiar with ADR, but anyways, don't tune out yet, this is important. A VIE is used to establish ownership of a company through legal agreements as opposed to direct share ownership. So when you buy shares of Baba, you aren't actually buying a share of Alibaba. You are buying shares of a VIE based in the Cayman Islands who has an agreement with Alibaba. Another potential outcome an investor has to be aware of is if the United States were to go through with the delisting rumors. It would cause a massive shock. However, take note, there seems to be some confusion. Investor shares wouldn't just evaporate. You'd still technically own your shares. It would just be more difficult to trade without the secondary market. In turn, investors would certainly see a correction in share price, along with extreme overall market volatility if things were to escalate to this point. For a while, it did seem as if tensions were de-escalating. But considering the country's removal of each other's consulates, the potential ban of TikTok, and a lot of political jabs back and forth, which I'll spare you as we've covered it here on Quick Stocks many a time. But really, this is the primary reason that Alibaba trades at such a massive discount when compared to these large American companies. If Alibaba was a US-based company, which of course it wouldn't have had the same level of success if it was, but for a hypothetical analysis, the company would be in all of these large index funds and easily a trillion-dollar company, and perhaps the most valuable company in the world. So, with all of this in mind, what's our move? This is a tough one. Honestly, an investor should expect outstanding numbers when the company reports in August. And if tensions don't continue to escalate, nothing is stopping this company from becoming a trillion-dollar company. Well, as some of you know, we already sold off a majority of our Alibaba position, taking in massive gains. We held on to 15 shares, which currently has a market cap of under $4,000. Considering this represents pure profit, we plan on letting this position ride for, a decade to come. However, for an investor who is looking to start a position in Alibaba, one should ask themselves, are they comfortable taking this level of risk? And if they are, Alibaba does offer an interesting play. Of course, take it as a grain of salt. I am not a financial advisor. This is purely for entertainment and educational use only. Anyways, guys, that's all I've got for today. As always, the best investment you can make is to go long on Quake stocks. Hit that subscribe button now at 1,000 subscribers and plan an early retirement. I will catch you guys in the next one.